Good afternoon, everyone. And welcome to the Ford Foundation. I'm Darren Walker, and I have the great privilege of serving as president of the Ford Foundation and welcoming an esteemed journalist, a reporter I have enormous admiration for and whose byline I read religiously because it is always filled with facts and data and intelligence and insight. And he has taken all of that and decided to write a book about an icon of 20th century American capitalism named Jack Welch, and the company was General Electric. This is a book that has certainly stirred the passions and perspectives of many people. It is a book that I think is not only about Jack Welch, but is about the system of an economic system, a system of capitalism, a system of regulation that Jack Welch certainly helped to shape. But David, I would like to start by asking you why you felt, I mean, you've been a business reporter for many years, and so obviously you spent a lot of time with CEOs and talking about economics in this country, but why Jack Welch? There are a lot of CEOs, and in fact, you write in the book about how in our culture, in contemporary American culture, it's not priests, university presidents who are the most admired and written about, it's CEOs. So why this CEO?
Thank you, Darren. It's such a privilege to be here, and thank you to everyone at the Ford Foundation who helped make this happen. I've had the great privilege of interviewing you so many times that it's a little disorienting to be on the other side of the conversation for once. So thank you for having me here. The reason I wrote about Jack was really quite simple. When I stepped back and tried to look for one meta-narrative that would help explain what's wrong with our economy today, but also how we got here. And I started doing the work of trying to understand what that story might be. All roads led to Jack. And I'll share two quick examples of how that was the case. The first one was through my work on the corner office column for the New York Times. I wrote more than 100 columns interviewing CEOs and organizational leaders over 5 years, including one Darren Walker. And over, Jack Welch's name kept coming up. Some CEOs would invoke him as their idols, someone that they were still trying to emulate in their business practices. And others would invoke him as someone who they were trying to do everything they could to do the opposite of what he did. And so I just realized he was still sort of living rent-free in the minds of today's CEOs, and that bugged me initially. And then there came this moment in the year after the second Boeing 737 MAX crashed. And I was one of the 2 reporters at the New York Times that really dug in to that story and did a bunch of investigative work to understand what had happened at that company. And it very quickly became clear that there was an engineering story that was relatively easy to understand, but that there was also this deeper cultural story, that something had changed inside the Boeing company over 25 years. And when I started to unpack that story, it was the story of Jack Welch. 3 of his protégés had taken over that company starting in 1997 and deliberately reshaped it to be a company that, in their own words, was a company that Jack Welch would be proud of. They tried at every level to remake Boeing in GE's image. And tragically, the results left 346 people dead. When I put those things together, it became clear to me that this was the story that helped explain this difficult moment we're in.
But you also, I mean, just let's take a step back because you, in the book, talk about the context. So Jack Welch, there were precedents, there were policy changes, there were things done before Jack Welch became CEO that might have facilitated or accelerated his rise and the rise of his ideology about business management. So you talk a good deal about Milton Friedman. Mm-hmm. So explain Milton Friedman's role in Jack Welch's success.
Yeah, you know as well as anyone, Darren, that there's a big difference between sort of ideology and action. And I make the case in the book that for really a decade before Welch took over, there was an intellectual movement afoot, absolutely, in corporate America, in the ivory tower, in academia, on both sides of the Atlantic, to reassess the role of business in society. That work was underway as people sort of tried to make sense of the economy in the post-war years, the role of government. Some people felt like governments were overreaching at times, that there were too many constraints on the economy and that was inhibiting competitiveness. And so men like Friedman and before him Friedrich Hayek started rethinking the role of business in society. And Milton Friedman famously wrote in 1971 in the New York Times Magazine, "The social responsibility of a business is to increase its profits." But those words hung out there essentially unacted upon for a decade. And it was really only when Jack Welch took over GE and took control of a company, and I hope we can talk about the influence that this company had in the course of America. A company that was not only among the most influential and successful companies in the country, but also the one that sort of set the precedent for the way other CEOs and companies operated. It was only when Welch took control of that company and had such a singular focus on putting shareholders first above all other parties that ethos that Friedman articulated started to become reality in this country.
And there were policies that were changed, right? So Jack Welch becomes GE CEO in
1981.
And in 1982, the Securities and Exchange Commission decided to reverse policy around the issue of companies buying back their own shares. Prior to 1982 was considered manipulation of the company's equities. And in 1982, the SEC changed that rule and said actually it is legal for companies to repurchase shares. Talk about how stock price becomes this obsession for Jack Welch and GE and ultimately for many other captains of industry.
Yeah. Well, I'll get to that, but I think it's important to remember who was president in 1981 and 1982. And these are the fruits of Reaganomics. And Reagan came in to office and stacked the government regulatory apparatus with Wall Street insiders. And when John Shad takes over the SEC in 1981, it's the first time a banker has run the Securities and Exchange Commission in 50 years. And what's one of the first things he does? He allows buybacks, which, as you said, had for 50 years been considered stock manipulation, because that's what it is. And so what does Jack Welch do when he sees that buybacks are suddenly legal? Well, GE is the first company to commit to spend $10 billion of its profits on buying back its own shares. And thus begins this inexorable rise under Welch of GE's stock price. And that was all very deliberate. That was all very intentional. Jack Welch came to the job with a singular mandate, which was to make General Electric the most valuable company in the world. Not to make the best products and services, but to inflate the stock price of that company as much as he could. And he understood that one easy way to do that was to start buying back its own stock in droves. And what's so important to think about is where that money used to be going. That $10 billion that he was suddenly spending on buybacks was $10 billion that, absent that regulatory change, would have gone to his workers, would have gone to CapEx, would have gone to research and development, would have gone back into the communities where GE had for so long been a model employer, and all of a sudden was going back to investors in the form of buybacks.
Now, is it fair, David, to attribute, I'm sure that Jack Welch would say that by becoming the most valuable company in the world, you couldn't do that by making bad products. No. I mean, you couldn't do that by having your customers be angry at you. You couldn't do that by having your employees be unhappy. So I'm sure you don't say this in the book, but I would imagine someone who would defend Jack Welch would say, implicit in that aspiration of being the most valuable company in the world was to be a great employer, a great citizen of the community, a great product developer. Have our consumers, I mean, you can't be that without those things as precedent.
I respectfully disagree. He got away with it. And here's how he did it. Here's how he did it. Yes, GE was still making lots of good and reliable products and services during the 1980s and 1990s. But no, GE employees were not all fine and dandy. Remember, before Jack Welch was coined manager of the century, he was known as Neutron Jack because among his first actions in his years as CEO was firing something like 120,000 people practically overnight and shutting down factories. He went to war with the unions. He never faced a national labor strike, but he steadily diminished the percentage of union labor by embracing outsourcing and offshoring. So undoubtedly, there were lots of industrial products that GE was still making that still bore the GE meatball logo and are still out there today, and they still make some good products and services. I give them credit for that. But what allowed him to make GE the most valuable company in the world was not those old line industrial products and services. It was GE Capital. And it was what he did with the finance division.
So talk about GE Capital, because obviously it features prominently in the book, and it, as you outlined very well, it became a source of, well, it became a huge cash cow for the company.
Jack Welch, right before he becomes CEO, this is in the late 70s now, he's given control of a few different divisions as sort of his final test before they decide if they want to make him the next CEO. And one of them is the finance division, this unit that would become known as GE Capital. It, for the longest time, had been essentially a pretty low-profile lending arm of the company. So consumers could, finance large purchases that were previously out of reach. He recognizes, however, that Wall Street is about to change. Money is starting to move in these new ways. The animal spirits were sort of unleashed on Wall Street. And he saw an opportunity, and he writes in a memo that nowhere in the organization is quantum change needed more than in finance. He understood that there was an opportunity to essentially make GE an unregulated bank. And so systematically, he starts pushing GE into all sorts of arcane lending businesses. You see GE buying commercial real estate portfolios, starting to dabble in high-interest credit cards, buying leasing businesses, going far afield from what had made them the greatest company in America for so much of the 20th century, going far afield from the industrial businesses that they knew so well. And ultimately, GE Capital, making money with money. And he writes about this in his autobiography. He says, I was amazed at how easy it was to make money with this. You didn't have to have factories. You didn't have to bend metal and scrape for nickels and dimes. You could essentially print money with money. And he was infatuated by it. And GE Capital becomes, as you say, not just a big business, but far and away the largest source of profits at the company, at one point accounting for something like 60% of profits and 40% of revenues at a $600 billion company.
And so the philosophy, the sort of, you talk about the sort of the way in which, in some ways, it becomes an amoral company. I mean, his sort of Darwinian philosophy and the kind of ethos of if you fail, it's because of your own weakness and frailty, and not because the company or the environment here is hostile to your success. So, do you think that he truly believed that companies need to be the kind of places where every year 10% of the population just needs to get fired? I mean, which was basically what you write about. I mean, he on an annual basis.
He invented that. He invented stack ranking. That was exactly what he believed, and he said as much. He said, I don't want my employees to count on the company, essentially. And this was this radical revolution in how corporations thought about their contract with their employees. You go back and you read things like the Johnson & Johnson credo. Tom Watson's writing about the role of IBM. Even GE's annual report from 1953, which articulates all the ways in which it believes it contributes to society. And Jack Welch just turns his back fundamentally on that and envisions a much more, as you say, ruthless Darwinian contract between employer and worker and between the company and its community. And he was overt about it. Now, I think you used the word amoral. He didn't talk about morals and ethics a whole lot, which maybe shouldn't come as a surprise. But I think it points to the fact that he believed that he was playing the game as the rules of the game were written and were to be played at that time. And when he was pressed on it, that is essentially the language he would revert to, that he was doing what was expected. He was doing what he could get away with. And listen, it worked for a long time.
And the idea, and this notion of investing in employees. I mean, they set up this GE University. I mean, it's not as if talent was just completely expendable. I mean, literally, they were spending millions on training people, on leadership development, on management.
I think there's a difference, though, between how they treated their executives, of which there were thousands at a company the size of GE, and how they treated their factory workers. And there, I think we can see pretty stark differences and a real indication of where Welch and his protégés placed value in the kinds of human capital. When it came to executives, sure, if you were executive at GE during the Jack Welch years, if you could keep your job, you probably did all right. If you were on the factory floor at any number of locations around the country, you essentially saw your wages stay flat. And if you were lucky enough to own GE stock, that kept going up until it didn't, when GE stock sort of crashed not long after he departs. But I think we can't confuse the way Welch and GE really coddled its executives and created this sort of culture of the imperial executive, of which he and his successor Jeff Immelt were the most iconic ones, and how they really treated the hundreds of thousands of workers on the factory floor.
So I want to pivot and because you write a bit about Jack Welch's childhood, and that often has a lot to do with why adults act the way adults act. And so in Welch's case, he's born in I believe somewhere in the Northeast. He is a short-tempered kid.
Yes.
Talk about Jack Welch.
Full disclosure, I am not a psychoanalyst, but I'll have to get a little Freudian here. It's important to remember, as you say, that these formative young experiences do shape who we become. And among those sort of signature moments in his autobiography, and this is from his own writings and conversations with lots of people who knew him well, he, as you say, grew up. He once uses the phrase, with my nose pressed up against the glass. He always felt like an outsider looking in. His family was very poor, and so there was a sense, and he asks the question at one point, I read in an interview he did with Harvard Business Review. He said, I wondered why my family wasn't more successful. He was mostly raised by his mother, who was a devout Catholic. His father was around, but mostly out of the picture. He was a unionized railroad conductor. And his mother really pushes him to compensate for his short stature and their relatively low station in the world by becoming incredibly aggressive. And she teaches him not only to be an altar boy in the church, but also to learn how to gamble, play poker as a boy with his allowance money, and gives him this visceral sense of winning and losing. He's a hockey player, and he's known to be really aggressive. He also has a short temper. He's caddying at the local country club as a young man, and when the man he's caddying for asks him to go retrieve a ball that had gone on into a pond, he throws the man's clubs into the pond and storms off. And so this gives you a sense of his temperament as he then goes on to do very well in university. It's important to note this man was incredibly sharp, incredibly hardworking, get his first job at GE, and rapidly rise through the ranks.
And GE's history was that of being a well-managed company. Welch also said GE was a well-managed company. I mean, he didn't change the philosophy to say we're a poorly managed company. He continued to say we are the best run company in America. And so management, leadership, these things were important. But it sounds like what you were saying in the book is, yes, they were important, but it was the style of management. It was the philosophy of management. It was the approach to management that changed fundamentally.
Absolutely. And I would say it's not just the style and the approach, but what they were managing for. And that, to me, is really at the heart of so many of the conversations I'm trying to have is, what was the motivation? What was Welch trying to achieve? Well, he told you. He wanted to make GE and the GE company stock incredibly valuable. You didn't hear previous GE CEOs talking about that. And you didn't see CEOs in what is known imperfectly, albeit, as the golden age of capitalism, these post-war years when the middle class really took off, talking about that either. They talked about, again, striking a balance between the interests of workers, customers, society, the government even. In the 1953 GE annual report, which I referenced, they talk about how proud they are to pay so many taxes. When was the last time a company talked about that? And so, yes, Welch continued this tradition of making GE an effective manager, but what they were reaching for with every one of those decisions, I think, fundamentally changed.
Well, and the other thing that changed, I think, is media coverage. I mean, as you say, during this period, the treatment of CEOs became, they were deified. I mean, the ways in which CEOs, and most notably Jack Welch, was covered by many, including your institution and other media institutions, was that these were rare, extraordinary men, because they were all men, extraordinary men with special skills and talents, and with great reverence. Business journalists wrote reams and reams about the greatness of these men and the greatness of their approach, and amplified, elevated their radical approach to business.
I found this academic study where a pair of scholars actually did sort of a meta-analysis of all the media mentions and stories about Welch over the course of something like 20 years. And it arrived at the conclusion that it essentially followed the hero's journey. It was like Campbell-esque in the way that Jack Welch was portrayed in the media. And that to me just said so much about how we think about and elevate our leaders. And it's how I start the book. I sort of start with a reflection of why is it that we put our CEOs, people managers who are paid, overpaid, up on pedestals. These are our cultural heroes today. I think that should be a prompt for some broad self-reflection as a society. But let me hasten to add, I'm a part of this. As a reporter for the New York Times, as someone who wrote the corner office column, this book and the last couple of months of talking about it has really caused me to pause and sort of reflect on my own role in this ecosystem. And I would be lying if I didn't look back on some of the corner office columns I wrote, not yours, and wonder if I didn't miss something, if I didn't miss the opportunity to dig deeper and ask much more fundamental questions about that individual's impact on our society.
And so what went wrong? I mean, the company was the most valuable company, the most revered. Jack Welch personally received just about every honor and every honorary degree in the country. From every prestigious organization and especially business organizations. And so what happened?
Well, he went out just about on top. For those 20 years, the stock sort of didn't budge for those first few years, but then it went up real fast, real far. It was made the most valuable company on earth. It remained that way for most of his tenure. It was sort of extraordinary. And everything was looking pretty good. And we talked about some of the ways he was able to do that with earnings management, by turning to GE Capital for profits, by smoothing out those earnings, we didn't talk about this, but he made 1,000 acquisitions in the course of 20 years, about a deal a week, and so enlarged GE with inorganic growth, essentially just buying earnings wherever they could. So that recipe worked right up until about the end. There was a little wobble in the last couple of years for a variety of reasons, the dot-com bubble, but Welch went out more or less on top. Almost as soon as he leaves, though, things start to go south. His last day on the job was September 8th, 2001. 3 days later, the world changes. And listen, Jeff Immelt, his successor, we're going to have his hands full no matter what. But I've talked to Jeff about this. And Jeff said, all of a sudden, he started looking under the hood of the company that looked so invulnerable, invincible. Analysts and stock market analysts and Bill Gross, the bond investor, start looking under the hood, and they start taking a much closer look at what GE was really all about. And suddenly it's not at all quite as pretty a picture as a lot of people were led to believe. And it's important to remember, this is before Sarbanes-Oxley. This was an era of much, much looser financial disclosure. Companies simply didn't have to tell the public quite how much was going on. It was much less detailed financial reporting. And from that moment on, Jeff Immelt, over the next 16 years, really struggles to right the company. And bit by bit, the GE that Jack Welch had assembled starts to come undone, even as Immelt tries desperately to keep this formula working. And the most vivid example of the way he did that was trying to double down on GE Capital in any way he could, which leads him in 2005 to acquire WMC, which was the largest provider of subprime mortgages in the country. And so all of a sudden, when the financial crisis hits, here's General Electric, the company founded by Thomas Edison, holding a toxic portfolio of subprime mortgages. That's the legacy of Jack Welch.
But Jeff Immelt was blamed for this. I mean, in the public's eye, and how many times have I heard people say, "Look at what Jeff Immelt did to that company," or in a boardroom say, "We have to make sure we don't make the kind of mistake the GE board made in going from Jack Welch to Jeff Immelt." And so the notion that actually, maybe until your book was published, his stature was solid, is in that it actually, the fault of why General Electric isn't listed anymore is because of his successor, not because of Jack Welch.
I asked Jeff Immelt about this, and these two men were as close as two executives and colleagues could be at the time of that.
Well, he was his
succession.
protege.
He was his protege. Things soured, and we get into that in the book, and I've had exchanges with Jeff just in the last couple of weeks publicly where we sort of go back and forth. But I think it's important to note that I asked Jeff Immelt about this in my reporting for the book. We talked about why he felt the need to buy something like WMC in 2005. And I asked him, why didn't you take that opportunity in the months after September 11th to essentially reset the company? If he saw in that moment that, wait, this company isn't quite on such solid ground, why not take the opportunity then and there to say, we got real problems, we're going to address them. And there's going to be structural changes, and the stock might go down for a couple quarters, but guess what? In the months after September 11th, everyone's stock was going down. He told me, I had a window, I had an opportunity. And then he said this phrase that I think I'll never forget. He said, but it was so seductive. The allure of just hitting your earnings was so seductive that the status quo prevailed. And they kept doubling down on finance. And GE Capital kept getting bigger, even in those first few years of the 21st century. And that led it. So was Jeff Immelt the one who made the decision to buy WMC? Undoubtedly. Was it a continuation of the strategy that Jack Welch set in motion decades before that? I say without question.
Speaking of questions, I'm sure this audience has a few for you, David Gallis. So I am going to ask you to raise your hand and please ask David Gallis your question. We have three. Here, sir, ma'am, you there, and then here. And we have mics. Oh,
Mic
thank
runners.
you. We do have mics. This is the Ford Tech team. They are so ahead of me. So you have to get up and go to the mic so that we can all hear. So please.
Oh, it's over there. Yeah, there is a mic.
On each side,
either
we've got a
stand.
mic. So
Look at
please
this.
go to the mic and ask David Gellis your question.
Hello, thank you so much, and I really look forward to reading your book. My question is about the relationship between the consulting industry and this myth of the superhero CEO, and in particular, the GE model, because I think the consulting industry had a very heavy role in taking the sound bites that came out of GE and then applying them. So whether it's outsourcing or executive pay or just even the kind of executive training model that Crotonville put in place.
Yeah.
Great question. Yeah.
That's terrific. You're making me realize that there was a chapter I didn't write. I have not gone deep on the consulting industry. My colleagues, Mike McIntyre and Walt Bogdanich, have a big book about consulting and their role in the economy coming out soon. What I would say, though, is even aside from the consulting industry, I'm sure they helped propagate and disseminate this virus of what I call Welchism. But beyond that, it was going to spread organically. And we didn't talk about it much, but Jack Welch personally trained the CEOs of dozens of other American public corporations. GE was known as the place where you go to get your CEO well before Welch showed up, and it continued under Welch. And what happened is as more and more men, they were all men, studied under Welch and learned how to maximize short-term profits in all the ways that we've talked about, they took that playbook and put it to work at Albertsons, Home Depot, 3M, Boeing, Conseco, Chrysler. The list goes on and on and on. And in almost every case, it ended in disaster. Yeah.
Yes, sir.
Hi. Before Mr. Welch garnered all this attention as a god, Business Week coined the term hollow corporation. And the model that they looked at was Liz Claiborne, which was a fashion label. Here in the city, but they did not make anything. They simply designed and marketed. And it was looked upon as the model of, we don't actually make anything. That becomes a very critical thing of which GE is part of, because GE was, as you know, an icon of manufacturing and of American engineering prowess. Very important upstate. So if anybody wants to know why is upstate a mess, there's no GE, no IBM, no Kodak, etc. And these were globally important cutting edge things. And we still haven't gotten out of that thing the idea that we don't have to make anything, which also means you know how to make things.
Right. So do you have a question, sir?
So could you say something about where this comes in? And you said a specific thing about Mr. Welch's nose pressed against the glass about his poor childhood. Andrew Carnegie had a poor childhood.
Right.
And Andrew, as imperfect as he was, becomes a great philanthropist. Right. And by the way, one of those things from another company that hollowed out but left the endowment of this foundation, if you look across at the towers in Long Island City, that was into the 90s still the most solid manufacturing area within the city. And it wasn't about garments, it was about precision instruments. And one of the companies that was there that made those was Ford.
Okay. A lot there. There's no doubt that Jack Welch looked to minimize labor costs. And a key way he did that was by turning to offshoring and outsourcing. And so this was, and here, you challenged me earlier, and I want to acknowledge that the economy was going to change no matter what when Welch took over. In 1981, the industrial economies like Germany and Japan were coming online. Globalization was going to happen in one form or another, whether or not Welch was named CEO of GE, and all sorts of other factors were going to happen. But the degree to Welch embraced it and sort of went whole hog on it, set the tone for the way the rest of corporate America behaved. And his relationship with domestic manufacturing was best summed up by a remark he once made, which he said, if I could have my way, I would put every GE factory on a barge. And that way, it could float around the international waters, chasing favorable exchange rates, cheap labor costs, and light regulation. That was his platonic ideal of a factory for GE.
Yes, sir.
Yes, I'm Klaus Müller. I'm working for Society and Diplomatic Review. And I have a question, but I'd like you to give me a long answer. If you compare the GAR culture that you described, marvelous, it's also just with some footnotes, and you compare to the contemporary corporate culture, what are the differences and what do you think is the most significant? Has there really been a change? Thank you.
Thank you very much. Compare and contrast are always long answer. Okay, I'll say this. Here's where I think things have gotten better since the Welch days. I think on balance, his alpha male, bullying, testosterone-fueled, screaming at his colleagues, let's be frank about it, sexist and at times with racist overtones behavior throughout his career, which is well documented, is by and large unacceptable in corporate America today. And I think those that try to perpetuate that kind of a culture inside a large, mid-sized, or even small organization usually don't last very long. I think we've made strides on that front. I think it's also true that whereas Welch was truly channeling Milton Friedman and had a really singular, myopic view of the role of business in society, many CEOs today are at least talking about their responsibilities in a much more holistic way. You've heard all the talk about stakeholder capitalism and CSR and ESG, and all of this in my mind is part of the pendulum starting to swing back perhaps in the other direction. Nascent as that progress, I believe, is, however. What I don't think has changed is the real fixation at the end of the day on stock price and the real fixation at the end of the day on the shareholder primacy above else. And I think it's so hard to change because structurally, to really make progress. And as a director of 3 for-profit major corporations in this country, Darren knows this better than just about anyone in this room, it is incredibly difficult. If you want to go to your investors, to BlackRock and Fidelity and T. Rowe and say, listen, we'd like you to take a few less points of EPS this quarter because we're going to do some good in society, that's a hard conversation to have, I got to believe. Because they say, well, my retirees are counting on you, thank you very much, no thank you. And when that activist investor comes along, you can be sure we're going to support a slate. It's not that simplistic, but these are some of the dynamics at play, which I think makes structural change real, the kind of structural change that would, in my view, start to alleviate some of the deep structural problems we have as a country, making it very, very hard to see the change we need. I hope that was long enough.
Oh, that covered my question. That answer kind of covered my question.
Okay.
My sister calls me Polly, so, for short for Pollyanna. So I suppose you've sort of gone down that road a bit, because the thing that I was going to ask is, when is customer going king? I grew up in the age of the customer is king. Mm-hmm. And is there any sense that before I die, I'm going to see that again? That may be, I'm an old woman, so who knows?
Well, it's so interesting. The customer focus right now is actually starting to be used by opponents of ESG and stakeholder capitalism as a counter-narrative. They're telling CEOs that are talking about investing in their employees more and taking care of the environment and caring about their communities to say, no, you've jumped the shark. You got to be just focusing on making great products. So, the semantics around the push and pull about where a company really needs to be investing its time and its efforts and its profits is, in my mind, endlessly fascinating. But I would just caution against believing that sort of a focus on the customer is really going to get us to a Pollyannish place.
So is there anybody equivalent to Jack Welch with that kind of power and vision, to Zuckerberg and not all of those folks notwithstanding, who can kind of lead that charge? Do you see anybody like that?
I identify in the book a couple CEOs who I think in their own ways, though not completely, are starting to undo some of the work of Welchism. And I point to CEOs who are raising wages for employees unprompted because they asked that critical question of what is the lowest paid person in my organization's life like? When CEOs at big companies really ask themselves that and sit with that question, it's often not an answer they're comfortable with. And so I point to CEOs who are asking that question, confronting the answer, and taking action. I highlight CEOs who have tried, in its difficult work, as we just discussed, to get out of this quarterly game of just trying to meet Wall Street's expectations, hell or high water, and finding measured success. But I don't think there's anyone who has the scale and the power that Jack Welch does, full stop, and certainly not anyone with anything approaching that kind of power that is putting it to good use to make our world a better place. Yeah, we got a long way to go still, Polly.
So we've got 3 questions here. Yes, sir, you were next, and then we'll come to this side.
Mr. Gillis, I think you've alluded to some of the things that I was curious about, but you reference a quotation from Friedman in '71, and when Jack Welch came along and over a long period of time transformed General Electric, the world was also being transformed. Mm-hmm. The gold window closed in '71. We had the oil shocks. We had a whole lot of things. We had the creation of NAFTA. We had the ending of the General Agreement on Tariffs and Trades and the creation of the WTO. We had the dot-com boom and all those things. Isn't it sensible, though, that a CEO, with all that, with the world changing over a long period of time, we're talking, and maybe his run wasn't quite 50 years, but over a long period of time, a corporation has to be driven by some fairly simple things. And by the way, we talk about Wall Street, everybody in this room, except perhaps you and the Fourth Estate, are shareholders. And so this is about us. So, shouldn't a CEO have a few basic principles, including those people in the community who have invested in his company to make it great and to return something to them? That's really the bottom line. And having a basic principle like that, that's your North Star.
Right. So I am not here suggesting that corporations don't make a profit. I'm not sitting here suggesting.
But that they have to adapt over time.
Absolutely. And I think Welch, if we're talking about the ways in which he adapted, overcompensated to the detriment of just about all his other stakeholders. The argument I make is that, yes, shareholders, investors are one stakeholder among many, but that on his watch and, in channeling Friedman, he essentially prioritized them to the exclusion of all others at any cost.
Them is us. The shareholders are most of America.
Okay, well, I feel like I'm answering and you're not liking the answer. I hear what you're saying. Yes, investors, many of us in this room are shareholders. But a company affects society, affects its community in myriad ways, not just through the wealth it creates in like the 401ks of those people who happen to hold its stock. They affect the livelihoods of the people who are employed or fired. It affects the livelihoods of those families. The tax dollars they do or don't pay affect how much money communities have for schools and roads. And all of those things changed on Welch's watch.
Well, and the other data point here is that actually, while it is true that shares, equity exist across society, it's highly concentrated. And actually, fewer Americans as a percentage of the working population actually own equity today, in part because in the economy that David writes about from the 50s to the 90s, workers were more likely to have equity.
Yes.
One of the phenomena that occurred beginning in the 1980s was the move from defined benefit programs, which actually contracted, and my grandfather, who was semi-literate with a third grade education and worked as a porter in a company, was an owner in that company, as was every employee of that company. Today, that same company, which has been purchased 3 times since 1986, workers are no longer, except management, are no longer, so certainly the porters actually the porters are outsourced now. I mean, my grandfather wouldn't even be an employee of the company. But the point is, you are right, sir, that we are, but even in this regard, it is concentrated, and fewer as a percentage of us are actually owners. And there are higher levels of concentration among wealthier of us who actually are owners. And so we are less today an ownership society than we were 40 years ago. And I think that has been harmful, and that certainly contributed to the kind of inequality that you write about. We
Absolutely
have
right.
questions here. Yes, sir.
Hi. I can't believe I'm going to ask a 2-part question because I hate 2-part questions.
We love them. Go for it.
But why do people ask them? Anyway,
That makes it a 3-part question.
so I burned one of my questions, which is great for everybody in the room. I'm actually wondering if you can talk about the culture of the CEO, because one of the things that's really striking to me about Jack Welch is I grew up with him being a very famous person who I didn't know what he did. I didn't know, maybe I knew GE, that he worked for GE, or worked for GE, ran GE. But I'm noticing this cult of CEO celebrity. I mean, obviously it ran the country for 4 years and wants to do it again. I'm also noticing that, we're trying to reckon with a thing that we don't want to let go of. There were 3 shows on at the same time about scammers at the top of these companies, one of which is still, I don't know how y'all got here today. I'm sure somebody got in an Uber. And I'm curious to hear you talk about, at least in the case of the Theranos story, and to some extent Travis Kalanick, those people would not pick Jack Welch as the people they idolize.
So do you think that they would say they idolized Jack Welch?
I think Kalanick might
Maybe
have.
he would. But Steve Jobs seems to be some sort of moral washing to some extent when people talk about these values. But I wonder if what we're really talking about ultimately, no matter what after 1980, is Welchism.
Yeah. Thank you. I think I don't want to overcomplicate it. I think we are infatuated with money in this culture, and CEOs are the absolute apotheosis of that up from your bootstraps American success story, which is so revered and misconstrued and simplified and sort of distilled down. And it's like our little reptile brains think that CEO equals success. And so it's so easy with that framework to look past all their sins. And that to me is some of the underlying context that helps explain the degree to which we grant white-collar criminals so much impunity in this country.
But don't you also, because you write about the fact that other institutions that were once revered have lost status. So the church, and so government.
Government.
And so society needs something to look up to.
Without a doubt. And this is, Darren and I have been engaged in this conversation for probably 7 years now, talking about the ways in which CEOs are our new moral leaders. And what that says about us as a society, that we are now at a place where the leaders of for-profit corporations are the people we look to for advice, for guidance on how we need, maybe we could silence that phone, how we could, why it is we look to them to weigh in and sort of set the agenda on some of these most contentious issues. And that the backdrop for that, the context, is undoubtedly the erosion of public trust in religion, in community, and in government.
Last question, please.
It's a short question.
I'll give a long answer.
You may have to, because I'd like you to comment on the roles and responsibility of the boards of directors of the company. And I would love to hear actually both, as a director, I would love to hear both of your perspectives on it.
Yeah, I would love to hear his perspective on it.
You have heard my perspective.
I ask him all the
about
time.
my perspective and gotten me in trouble.
I have. You're generous to still have me after some of the stories I've written about you, Darren.
It's true.
Oh, I'm remembering that one. Okay.
Am I going to go first or you're going to?
No, I'll go first.
You're going to go first. You're the expert.
I think it's, you're absolutely right to go there. Without a doubt, boards have a fundamental responsibility. And I would argue even a greater one than the CEO in some ways, because it's the boards that ultimately choose who the CEO is. And boards have the opportunity to select in their CEO and president someone who embodies the ideals, the values that they most want to see manifest in that corporation. So when they keep looking for, the boards that go back to the well over and over and over again for shareholder maximizers, well, guess what? That's what you're going to get. One of the things I point out in the book is the story of one company, Unilever. I'm careful not to sort of give too much credit to any one company because there's a lot of imperfection everywhere you look. But what Paul Pullman did when he ran Unilever for 10 years was very deliberately turn over his board and essentially put in a board in place that he believed was going to choose a CEO that would continue some of the progress that he believed he was making at that company. He did a lot of work to try to undo the work, undo sort of shareholder primacy, to clean up the supply chain, to double down on combating climate change in all sorts of ways. And he recognized that moment of succession is such a perilous moment in a corporation's evolution. And if they don't get the right person, all that work could have very quickly gone out the window. Now, they selected someone, Alan, who they believed and I think is doing admirable work trying to continue that legacy. But lo and behold, there's all of a sudden an activist in the stock. Lo and behold, that activist is now on the board of directors of Unilever. And so even after a decade of real admirable progress, I think even a company like Unilever, which has been held up as a model of sort of anti-Welchist practices, is now at a moment of real uncertainty. So the boards have a huge role to play.
Well, and the boards are themselves, I couldn't agree more. And as you and I have discussed, it is the board's ultimate responsibility. And the board itself is part of a system. And that system it has incentives and disincentives that in some cases actually discourage the kind of courage that is needed in order to serve the shareholders and the employees, because bad things happen when your stock goes down. You lay off people. Yeah. So it's not as if by keeping a focus on share price, it's only about inflating the value of the company. That allows the company to continue to employ the numbers of people it employs. And I do think, David, that there is no doubt that boards today generally are not looking for that model. I have certainly in one company, as you know, been on the search for the CEO, and I can assure you a value set like that was not attractive to the board. What was attractive to the board were things like empathy. Does this candidate have the capacity to work in a multinational, multicultural setting? Do they understand the context and the sort of socio-political environments in which the company operates? Because it's not hard to find a strong operator. And so if you're, whatever the industry is, you're probably growing that talent. You've got a bench. And then if you're a highly desirable company, you can always go and take the COO from a competitor, right? And so talent is out there, and boards have become much more, I think, rigorous about these qualities that are more interpersonal and sometimes feel intangible. Absolutely in the wake of Me Too. You're right. I mean, there was no Me Too. Was the opposite. I mean, this period of time was contributing to the buildup of a period when women and cultures just simply revulsed at some of the kinds of behaviors that companies were embedded in companies, and that was tolerated. So I think it's different, but it is this question of the system, particularly analysts and the way the company is covered and is written about and is assessed, which does impact share price and does make the company more vulnerable to the very thing that happened at Unilever, and that could happen at any company, and that changes the dynamic. One last question from a colleague.
Yes, thank you so much to both of you. It's such a joy to be here. I actually work here on the investments team at the Ford Foundation, and also have to lead the mindfulness program, which I know you've written a lot about mindfulness, which is fantastic. And lastly, I co-founded a group called Mindful on Wall Street, which is a grassroots movement about bringing more compassion and mindfulness into the financial services industry. And I say all this to say that what you're talking about this evening is something I think a lot about. And I was curious about your thoughts on compassion, which I know compassion can be seen as sort of a soft quality or touchy-feely, yet we're seeing science and a lot of studies written on the importance of compassion in leadership and in business. And I'm curious what your thoughts are on compassion in business, and what do you think can help to catalyze sort of hearts and minds to think about other people, to be less Milton Friedman-like, Jack Welch-like?
Yeah.
Great question.
I love it.
Compassion. What do you think about compassion in business, Mr. Business Reporter?
I think compassion without action is just words. And so when I hear you talk about a board looking for leaders with empathy, right? Like, that's great, but how does that manifest? What decisions? How does that make a CEO change the way they run their company? Because if it's not compassion or empathy in action, then it's like PR stunt to me. So I don't care if they call it compassion. I don't care if they call it empathy. What I'm looking for is leaders who are going to put their workers, their communities, their workers' families, the environment in a place of regard, in the same way that for the last 40 years, they've been placing investors in such high regard. That's what compassion in action looks like to me in the business world, and I hope we see a lot more of it.
Well, we hope we see a lot more of David Gellis, and I think maybe you want to tell us about what comes next for David Gellis. You've written this book. You're causing a big kerfuffle, and I've had friends tell me already via text that they are listening and always interested in what David Gellis has to say. You're one of those market movers. So what comes next, David Gellis?
Well, I'm thrilled to be here, thrilled to be talking about the book for the next several months. And I've recently changed roles at the New York Times. I'm now still writing about business, but squarely through the lens of climate change. And I'm really just trying to understand the impediments to real climate action. And as we think about making what I think is one of the biggest collective action problems humanity has ever faced, which is the wholesale restructuring of the energy system and really the whole economy, a transition to a low carbon economy at every level. That's just a massive story that I'm going to be writing about for the rest of my life, and people will be writing about long after I'm gone. It is the biggest story in the world, and we got to figure it out.
We look forward to following your byline. Thank you, David Gallus.